So the paper Climate Finance by Giglio et al. 2021 from the Annual Review of Financial Economics proposes two different sources of uncertainty, which implicates risk premium for financial assets. And these two different sources fundamentally view climate change differently. One of those models, which I call the direct model, considers actual climate events to be the source of risk for assets. And the other one, second model, which I call the indirect model, focuses on how economic activity impacts climate risk. So how investors view the source of uncertainty implicates what kind of assets they would be incentivized to hold. So let's unpack these models one by one. The first, or the direct model, is also the countercyclical model, and I'll come to the countercyclicality in a little bit. So, like I said, it holds actual natural catastrophes like floods, hurricanes, earthquakes, etc., as the source of uncertainty. So let's say, imagine that we own shares in a company that specializes in beach resorts. So let's say they have a lot of resorts in a place like Florida, which is vulnerable to sea level rising and hurricanes at the same time. So if a hurricane disaster like Hurricane Sandy or Katrina occurs, the resort will be damaged and its shares will lose value. So in this case, you have a double whammy. First of all, from the beach resort company's point of view, they have to spend money to repair the infrastructure, let's say fix the roof, declog their premises, etc. So they have to spend money instead of investing in other things or on marketing or advertising. So cash is necessary for them in this case, so it's a cash outflow. At the same time, there will be a general economic downturn. Why? Because a hurricane just hit. So people have less expendable or disposable income to go on vacation. So the tourism industry would suffer and overall economy-wide consumption would be low. So a double whammy, first through the expenses that the beach company resort has to spend, and also less inflow. Outflow gets larger and inflow gets squeezed. So how does this implicate the assets? In this model, within Model A, it's possible to imagine two different sets of assets. So in other words, the entire set of available companies, you can divide them in two ways. Bad assets, meaning assets that are positively exposed to climate risk, and our beach company is one of them, and others which are good assets or hedge assets, safe assets, i.e. negatively exposed to climate risk. So again, let's unpack these two sources of assets. So in our case, the beach resort will lose value exactly when the economy is struggling because of the hurricane. So to incentivize people who don't know yet when the hurricane would hit, they would require a higher return, i.e. positive risk premium, if they want to hold such a risky asset. In other words, this beach resort stock will have to outperform, let's say, the benchmark of S&P 500 or FTSE 100. Otherwise, no one has any incentive to hold these. That's why there is a positive risk premium. Now, on the other hand, for the negatively exposed or the hedging assets, I can use the example of insurance shares. Let's say there is another investment in a climate insurance company, which would gain value when a disaster like a flood will happen. So these shares act as a cushion or a safety net during hard times, during disasters. So people might be willing to accept a lower return, lower than the beach company return, to hold them. So you don't have to convince people too much to hold those shares because they're less exposed, i.e. lower return, i.e. negative risk premium. So you might even be able to convince people to tolerate a return that is slightly less than the S&P 500. So to sum up for Model 1, you can, depending on the exposure level, the risk premium would differ. If your assets are positively exposed to the climate events, then positive risk premium. But if they're safe during climate disasters, there is a potentially negative premium. Now, in the second model, the indirect model, it is more or less about uncertainty about the economic activity path. So it's an entirely different paradigm. Uncertainties in economic conditions are the primary cause, and climate risk is a secondary outcome. So it is assumed, it's a pro-cyclical view, meaning that in periods of high economic activity, climate risk is more pronounced. So when the economy is doing good, more things are being produced, people are consuming more, so consumption is high. So more oil tankers will cross the seas, more people would order from Amazon, so things will be shipped from the warehouse to our doorsteps, more CO2 emissions, etc., which in turn elevates the risk of climate risk. Now, before I proceed with the examples, I want to reiterate this point that the second indirect model assumes that climate events are more likely to happen when the economy is booming. Now, let's dive into the risk premium. Again, we're going to divide the entire universe of assets into good assets versus bad assets. Let's start with the bad asset, which was our beach resort company. So if we own a share in this beach resort company, it might perform poorly during a flood, but those events in this model, those events only happen when the economy is already doing well. Remember, high economic activity leads to climate events. That was our initial starting point. So since economy is already doing well, meaning tourism is good, we have a good cash flow coming in, the beach resort company is doing very healthily. So investors will not demand high return to invest in our beach resort in such a situation. You can also think of coal plants or other dirty energy companies as an example. So because investors do not demand a high return for these bad assets because economy is already doing well, there is a low premium. Even if they underperform S&P 500, not an option. Not a problem. So the premium is the exact opposite of what we saw in the model before. There it was high premium for bad assets, and now we have low premium for bad assets because we're already doing well with the beach company. Now, what about the good assets or the safe assets? In the previous model, there was low or even negative risk premium for those safety cushion assets. But now we have high premium. So let's say we have a solar panel company, shares in a solar panel company, or a carbon capture company, which does well when the economy is good, doing well. But since people already have a lot of investment options in good times and most companies are doing well, they would demand a higher return for investing in our company because there is no incentive to invest in a solar panel factory when a beach resort or a coal plant already is doing well. So for the solar panel to sweeten the deal for the investors to invest in the solar panel factory, it has to at least be on par with the beach resort or outperform that. Since that's not possible, investors have lots of choices, they would demand a higher return, i.e. a higher risk premium for these good assets. So now we can recap these two models. In the first direct countercyclical model, if you invest in something that loses value during a bad climate event, you would require higher returns because that loss hurts more when times are bad. In the second, the countercyclical model, in the procyclical model, or the indirect model, if you invest in something that gains in value when the economy is doing well, you would also want a higher return, but for a different reason, because that gain is not as valuable because you're already doing well. So you would want those assets to outperform other assets in the economy which are already doing well. So the reasoning is different, and that leads to the exact opposite signs of risk premium. So that's the entirety of Giglio et al.'s point. Their proposal argues that the risk premium demanded by investors depend on the nature or the source of uncertainty in Model 1 directly from climate events, and in Model 2 indirectly from indirectly from economic conditions, which secondarily implicate climate risks.